All right, today we are going to talk about some more complex tax strategies. And so, as our disclaimer, we are two certified financial planners. Jeremiah is also a California licensed attorney. And so, a part of the work that we do here in our office is talking about tax strategies. And we often work with business owners, high net worth individuals. There's different tactics and strategies to consider, but every situation, every portfolio is unique. So, I want to start this week's episode by giving that disclaimer that to have a team in place of experts, which include a CPA as well as financial advisors, that really brings it all together in terms of long-term planning is the best approach to developing your robust tax strategy. But today we're going to delve into just introduce some ideas, some tax strategies specifically for business owners that might be a little bit more complex than just your vanilla sort of tax plan.
That's right. And we assume people are already maxing out their 401ks. They're already making those types of contributing plans. But this is the next level. This is when you have more complexity in your life and what could be an item. And as Laura said, we're going to bring some items in the podcast and talk about them. But each situation, whether that actually applies to you, man, that needs a unique look from an attorney, a CPA, or someone who really knows your situation. So let's jump into some of these fun ones.
Yep, absolutely. Okay, so when we're talking to a new client, we always want to cover off the basics, right? We want to make sure that they're maximizing any retirement plan benefits that they have. We want to talk about charitable giving. Are they charitably minded? Do they like contributing to federally registered charitable entities? Now, we have many clients who are generous, but maybe they like to give to family members instead of registered charities, right? So we want to get a broad sense of where do they hold real estate, right? So there's a lot of different questions that lay the foundation of starting to build a more complex tax strategy. So apart from just talking about the traditional retirement accounts, we want to talk about, as a business owner, the entity optimization. As most of our listeners know, there's obviously different tax benefits and different tax structures to being structured as an LLC, an S Corp, or a C Corp. And so just as a quick reminder and tutorial to our listeners, Jeremiah, can you share with us just kind of broad brushstroke of what are the different tax implications of each one of those entities?
Yeah, that's great. And they all apply a little different for what you hold, as Laura said. So an example being, if you hold real estate, you very likely want that to go into an LLC. A key piece is when someone passes away, you get a step up in basis. Really, really powerful for real estate investors. Separate from that, if you have a C Corp, you won't get a step up in basis. And so you don't really want to hold real estate in a C Corp. So LLCs have certain characteristics that allow pass-through taxation, only one layer of tax, not a corporate tax. It also allows that step up in basis at death. Super valuable for those situations. Then you get to a C Corp, we just mentioned, is a kind of a traditional corporation. Really powerful if you're a business that wants to make the QSBS election, qualified small business stock. If you're a C Corp with the original issuance going to people, you can qualify that stock as QSBS. Really powerful to take about $10 million a gain and shelter it from capital gains. So if you're going to start a company and potentially sell it in the next 10 years, if that's the plan, a C Corp is really powerful. In that same type of vein, almost every startup company that I've worked with, whether it's biotech or a tech company, they're all C Corps. So it's just the way they're structured. It makes a lot of sense to go through the next sale, to be able to roll over some equity. There's some real good tax benefits. And then you have what I would consider like operating businesses. And most of those want to be S Corps. So law firms, CPAs, things that have good income, good steady income, and you want to maximize how that income goes to the owners. Often that's an S Corp. And there's no magic bullet in the sense that there's not one that's always right or always wrong, but it depends what the asset is, what we're going to do with it, then what kind of structure to get into that makes some major tax differences down the line.
Right. So tax optimization within your entity structure first. The second one, which I alluded to a little bit earlier, some charitable giving strategies beyond just the regular donations that you make during the year. So in years of high income, this might be the sale of a company or a portion of the company, right, where you can anticipate higher than normal income. These are great years to consider kind of a bunched giving strategy. And there's different ways to do that. We've talked on previous episodes about a donor advised fund, which essentially gives you the tax benefit within the year, and we often recommend this in moments of high income or high earning years, but it decouples it from the timing of the gift. So you can actually make that irrevocable contribution to a donor advised fund and receive the tax benefit within the same year, but give from that account to other charitable organizations over time. And those funds can be invested and they can grow. And this also turns into a legacy asset. So these are irrevocably designated for charitable purposes. Some of the other ones that people might want to consider in this circumstance is charitable remainder trusts. Those have some benefits to a charitable organization in the long term and some tax benefits when they're initially created. Jeremiah talked earlier about the step up in basis. So especially in these last couple of years, we've seen tremendous growth. Markets have been performing really well. And so you might look at your investment portfolio and see some large amount of gain built up in some of your holdings. And one of the ways to avoid capital gains tax rather than liquidate that holding is to actually donate the appreciated stock. And so as you donate that to a charitable organization, you then essentially get to write off the full market value. You don't have to pay taxes on the growth from the time that you purchased it or the price that you purchased it at to the fair market value at the time of donation, right? You get that full tax benefit in that year. And of course, as you gift it to a charitable organization, they don't have to pay taxes on that. So that's one way to receive the tax benefit there. So if you are charitably minded, there's a lot of different strategies that we can look at, and particularly couple these in years where you're either purposefully triggering higher tax like Roth conversion, or you anticipate higher earnings than other years.
Yeah. So good. So well said. And part of why we're in a little bit of a deep water here is these are not just the one-off December, what can I do to save some taxes, right? These types of strategies that we're talking, the next ones we'll talk through, are ones that need to be planned out, thought about, and really structured in ways that are multi-year strategies. These, I think for us, this is when it becomes fun. If somebody is not interested in charitable giving, then we don't use any of these. But if somebody says, yeah, down the road, I could see giving some larger amounts, or I give every year anyways, I'd love to formalize that. The opportunity to set these structures up in years where they sell a business or sell a property can be really, really powerful for someone's taxes. So like I said, they don't apply to everybody, but when they do, they become really, really interesting, really fun and exciting to talk about.
It doesn't mean that we don't still have clients that call us on December 20th and say, hey, wait, I've got to do some things to minimize my taxes this year, right? But in an ideal world, we've talked about it. We've prepared for it. It's a part of their plan. And so we're structured to maximize on those benefits on an annual basis. So this is another reason to keep in touch. If your financial advisor has talked to you a couple of years ago and then you really haven't heard from them, right? That's not an ideal relationship for most people. You want to keep in touch because every year there's opportunities to refine, change, and optimize the plan. At least we find that to be true.
That's right. Well, let's go a little deeper into the waters of some of the attorney side of trust items. Often we have families that are going to go past the estate tax exemption. Right now, it's fairly high with the recent legislation. It pushed it up. So it's about 30 million, which is a large estate. We have a number of clients who look at their business, usually business owners, look at their real estate, all their holdings together and say, ooh, I'm going to go past that. My children, if I pass away, are going to receive a tax bill, and anything that's over that $30 million exemption has a 40% tax bite. It's a really big bite. And for someone who has a private company that's grown and done really well, the idea of transitioning over and having that tax bill is really problematic. So what we start talking about is lifetime shifts of assets before death, knowing that there's going to be a big tax at death. We want to get some of those assets out of the parent generation's estate over to the child generation, the future generations. And some of the ways we do that the main ways is through trusts. So attorneys would set up certain types of trusts. Usually they're called irrevocable trusts, but there's a whole group of them, and they're outside of someone's estate. And they start moving assets into these trusts to get them out of their own estate, and they're for the benefit of the kids. So all sorts of complexities and when this might apply, when it might not apply. But there's a whole level of discussion that we have of how to get the ownership of these assets out of the parents' generation. And the first one I would say is it starts with valuation. Most people have a business. They say, hey, I want to start getting this to my kids. I want to get it out of my estate. I want to give them some ownership. I want to keep control. I just want to get my kids some ownership here. Often they think I'll just write down a number and give it to them. And that's not going to fly with the IRS. The very first step often is getting a formal business valuation from a third party that says, this is what your company is worth. That gives you the foundation to start gifting 2 shares or 5 shares or 7 shares every year so that you can stay within all the IRS guidelines of gifting, but still get the ownership transition to the next generation, getting it out of your estate. So we've worked through a number of those with clients, and they're really fun and interesting when we get there. But the flashing light warning here is this needs an attorney and a CPA and probably even a valuation expert that knows your business, knows what you're doing, and it's really advising you through these processes. But so powerful for multifamily wealth building.
Yeah. And again, time is on your side here. So if you are a business owner and you're just thinking about this, you're anticipating this sort of succession plan down the road, it's definitely something to start talking to your financial advisory team about, because there's certain structures that can be put in place to anticipate this, because it is kind of a complex process and something that you're going to want to do more than just 1 year. You want to kind of structure it over multiple years.
Yeah.
So,
Quick plug for Cal Baptist University here in Southern California. Yeah, the CBU Family Business Center. It's a great group and community of business owners who own, so families who work together and own businesses. And often the desire is not just to sell the business and exit, but it's to transition to the next generation. So much good content comes out of that group. And we've been a part of that group really since it started. But so many good advisors and peer-to-peer business owners that they're walking through how do I best set myself up and my family up for success without the kids being entitled or just nepotism, but actually to have a real wonderful transition of the business and the assets for family. So if you haven't ever attended one of those, it's a great resource in this area.
yeah, or something to look into in your region. They might have other family business centers across the country. There are other ones. I think the universities try to kind of create a network between them. But we've had great new ideas and conversations with people that we are a family-owned business. And so we're actually living this out. But also many of our clients are as well, especially where we're located. There's kind of a concentration of family-owned businesses, some of which are on the third and maybe even fourth generation, which is very rare. With each transition, there's some complexity, a lot of questions to be answered. Anyways, and so yeah, to have a team in place would be good. Have good resources. So we talked about some of the income shifting strategies. There's other opportunities. We want to talk about the sale of a company. You can do so not just through something like a family limited partnership or trust, but you could also do something called an installment sale. An installment sales is essentially creating kind of like an annuity where there's a purchase price, again, predicated by a valuation of the company. And this can be between family members or just another individual, maybe a partner in the company. And that the individual that wants to exit, right, can set up an installment sale, which is essentially an ongoing payment over the duration of their lifetime or 30 years. The terms can be adjustable. But this can basically spread out your tax liability. So rather than a one-time transaction and purchase of your equity within the company, it can be planned out over multiple years to spread out that tax liability. So installment sales are also a really great option for business owners looking to start transitioning out of the business, or at least to sell their position in the company.
Really, really well said. With that, also, we see opportunity zones. These were huge a number of years ago when they first came out, because if someone was selling their business, they could take the proceeds from that sale, roll it into an opportunity zone and invest in a building or some other business. And if they left it there, I think the original term was either 7 to 10 years. The way the tax code was written is all of the gain they had in the sale of their initial business would be forgiven as part of that next rollover investment as long as it stayed for a certain period. And so when they first came out, they were hugely effective. The legislation then changed a little bit, and so people get partial write-offs or partial forgiveness of some of that. They still exist today, and then the rules were just trying to extend them and reinvigorate those. But basically, it's these investments that you take a capital gain investment that has a lot of tax with it when you sell it, and you roll it into one of these opportunity zone investments, and you're able to avoid, delay, and sometimes even get forgiven some of your capital gains. So really powerful way to do it. I've advised a number of clients through these of you don't want to go into a bad investment just because you want to avoid some taxes. But some of these opportunity zones of the companies that build and develop are phenomenal investments on their own right. And then you couple that with being able to avoid some of these capital gains, it becomes really, really powerful. Definitely one to look into if you're selling a business, to consider, is there an opportunity? If I don't need the cash today, if I don't need to take out the money to live on, if I can roll that into something different, will it be powerful? And with that, one other thing I'll say is often when there are these larger business exits, there's often an opportunity to roll over shares into the buying entity. When you see like a private equity company that's buying out an operating company, the owners, the family members, as they exit, someone's can roll over their shares and become owners in the private equity group. Not always the right choice, but sometimes a very good choice because it delays the taxation on that rollover. And so rather than having to experience those, you do a partial rollover, get some tax benefits. So those are all very deal specific of whether or not those apply to you. But when we find clients in that deep water, man, there's some really good opportunities to explore.
And this is a good moment if you are a business owner and you're anticipating a transition to couple this with a personal financial plan because this is a key moment in your financial life to make sure that you get maximum benefit from the deal that's being worked out. And so to be able to look at just not the gross dollar figure, but how is that all going to whittle down and actually be applied both from a tax perspective, multi-year strategy, et cetera, et cetera. We find that oftentimes business owners come to us when they are anticipating some sort of major transaction in their company, and we want to make sure we're coupling that with a personal financial plan so that they receive maximum benefit. It helps guide the deal terms and the negotiations and things like that.
Yeah, so good. All right, the next one, I hear this a lot. It's funny. They talk about state tax
Yep.
optimization. And people, the easy version is I worked in California for many years. I built up my 401k. I now retired. I'm going to move to a state that doesn't have the same type of income tax. And as I take from my 401k, I'll pay much less tax. It's wonderful. It works out great. We see this on a regular basis. The dynamic is you have to move, and you have to, or if you're in California where we are, you have to sever nearly every tie with California. California taxes are very, very aggressive of going after businesses and people who leave the state but still have houses and things here. So in the retiring sense, that's probably the easiest version. What we talk about a lot and what we see a lot is people who are still doing business in California. They still have an operating business and they want to move their business out of California, but their life is still here and they want to try and make that work. And that becomes fairly complex and fairly difficult.
And the way to prove residency, we've done a lot of research on this because we've had different clients that say, oh, great, I can just move here and avoid all the taxes, right? So there's not just one proof of residency, meaning if you get a driver's license registered in that new state, it's kind of a multi-factor assessment that the IRS would do to say, are they in fact, have they shifted their residency to this new state? And so that means dissolving ties, like Jeremiah was saying, from the previous state of residency that you had. And sometimes people file kind of like a partial tax return for part of the year I had residence in this state and then I moved at a certain time. But they want to see multiple factors that justify your residency in the other state. And California is, shocker, highly litigious about this. So it's not something to take lightly. It is really important not just to register all your vehicles, have a permanent residence there. In fact, I remember you were talking about case law, that the deciding factor in the case was that the individual had actually taken their pet, their beloved dog, with them to the other state. So even if all other factors remained consistent, the one deciding factor was that they had moved their pet with them. And so that was the sign that that was their new permanent residence. So a little bit of a, I guess, call a gray area, but you have to kind of prove it by a multi-factor test about where your residency is.
Yeah. And sometimes this makes a lot of sense. I had a client years ago that did the math and said, we're moving to Nevada. We're going to move to Las Vegas. We're going to move the whole company out there. In order to accomplish it in a business sense, he moved business, all operations, closed the plant here, moved out there. He moved his personal residence. He moved his kids. He moved everything out there and became residents of Nevada and moved the business to Nevada. And as they completed that, they were now in Nevada, and they were able to file as such and appropriately. And after doing the math, they saved a significant number of taxes. They gave up living in California, and for some, that's not a problem. They'd prefer that. Others, that's a big concern of some of the benefits of living in California. But it's one not to take lightly, but it is something to make that move. It takes some planning and it takes some purpose, but there can be some real benefits.
Yep. So we've covered a lot of territory and again, kind of some broad, kind of deeper tax strategies on this episode. But again, just come back to the recommendation, have a solid team in place, have some experts counseling you on this because every financial circumstance is different. But just as a recap, we've talked about making sure that you've got the basic tax advantages in place, like currently, contributing to your 401k plans. We've talked about some charitable gifting strategies that are a little bit at a different level than just, regular cash donations during the year. We talked about income shifting strategies, and this could be a part of your succession plan as a business owner, and coupling that with something like an installment sale or other opportunities in the eventual sale of your company. And then eventually, we just talked about some state tax optimization. So there are many other topics. The tax law and code is continually being updated. We talked a couple of episodes ago about some of the impact of the big, beautiful bill. So if you haven't listened to that episode, we would highly recommend it. But do you have anything else to add there, Jeremiah? Did I miss anything?
No, I think you hit all these. And I think it's taxes are no fun. No one likes them. No one likes talking about this. But I love the moment when we find a tax strategy that's going to work for a client and we talk through it and we get it in place and then they realize the savings they're about to have and how wonderful that is. So we always tell clients you should pay every dollar of tax that's owed, but we can work within the system to try and minimize what's actually owed. And there's a lot of these strategies that are useful depending on your situation. So if you don't have someone in your life that's talking to you about this stuff and reviewing what you're doing, you need someone in your life that can fill that role. And that's a lot of what we do. So we're happy to talk to you if that's useful.
Awesome. To all of our listeners, thanks for being here today. We have a few more things to let you know about before we go. Podcast reviews really help us to serve more people and get this information into the hands of the people who need it. Please leave us a review. Even if it's not 5 stars, we welcome the feedback.
And we invite you to let us know what topics you would like to hear more about or what would benefit the people in your life who you're closest to. We have more resources online. Those resources are designed to help you share this great information easily with people in your life. To access those resources, please visit tricoreadvisors.com.
Often we hear from clients that they wish they had talked to us sooner. If that's you, we'd be thrilled to see how financial planning can benefit your life. Email us at contact@tricoreadvisors.com or simply click on the link in the show notes.
This show was produced by Graham Gardner at Model FA. Find out more about how to create a podcast for your financial planning business by visiting modelfa.com. We love creating content that's useful, resourceful, and maybe even a little entertaining. We want to make this mega universe of financial topics and advice applicable and helpful to your life.
Remember, at Tricord Advisors, we are your future's best ally.